Welcome friends to the class 32nd. In this class, we will try to simplify the balance sheet. This is a very interesting topic for you. This is kind of a financial analysis part in which you will totally understand how the balance sheet is made up and how we will easily decode the each and every item of the balance sheet. You will learn all this in this video and the coming video related to all the financial analysis and financial eligibility parts of the loan, right? So understanding the basics of balance sheet is what we are targeting in this video. So balance sheet of the business, I have written that the balance sheet of the business is as on 31st March 2025. This line is of significance importance for you. The balance sheet is always made on a particular date, and by this I mean that whatever balance sheet shows you, whatever data it represents the data of that particular date only on which it is made. Like for example, the balance sheet is made on 31st March 2025. That means whatever data it is representing, it is reporting in it, that data belongs to only 31st March 2025. The data may be different on 30th March, the data may be different on 29th March, the data may be different altogether on 15th of Feb, and so on and so forth. The data may be different on different dates, but what we are getting the position as on 31st March only, right? So this is how the world operates in a financial accounting system. So this is kind of a disadvantage as well of balance sheet. So we trust the data on 31st March 2025, and basis that data of 31st March, we presume the whole operations of 365 days of the business. We presume that this picture which is represented on 31st March might be the same in all other days of the year, which obviously is not an accurate assumption, right? So this is a basic disadvantage of the balance sheet, which we will cover further in later financial analysis, deep analysis part that we will cover in coming videos. So the balance sheet is on particular date on 31st March 2025. So what does balance sheet tell you? The balance sheet consists of two things. The first are the sources of funds. The business, the entity, the industry, from where they have sourced the funds. Whatever industry you want to start, whatever business you want to start, you need funds to start that business. Now that funds can be taken from multiple sources. You can invest your own capital, your own funds in the business. You can take the help of the banks, you can take the help of your family members, your relatives, you can take the help of any other third parties, you can take the help of your suppliers by asking them not to take payment for their supplies immediately, and kind of taking indirect investments of their in your business, right? So there are multiple ways to source funds for the business. So the balance sheets side, which shows the sources of funds, is called the liability side of the balance sheet. Liability side of the balance sheet shows the sources of funds, right? And then whatever funds you have sourced, must have been invested somewhere, to do the business, right? So if you are planning to start a business, you may be requiring a plot of land, you may need to construct building, you may need some machinery, you may need some furniture and fixtures, and more importantly, you will need stock, which you can process and sell in the market, right? So the funds you have taken from your own sources and multiple outside sources will be invested somewhere in the business. And if they are not invested in somewhere in the business, then they must have been kept in your bank account as a bank balance. Am I right or not? Right? So this is called usage of funds. This is called the from where you have sourced the funds, and this is called in which areas you have used these funds, right? These two are the positions that the balance sheets tell us on a particular date. And now this position is of 31st March 2025 only. As on 31st March 2025, from where you have taken the funds and where you have invested the funds, that is the basic two things which is covered in the balance sheet, right? The uses of funds side is also quite the asset sides of the balance sheet. Then this side is called the liability side. I have already told you. Now if you have sourced 10 rupees from multiple sources and you have invested 9 rupees, there cannot be difference of 1 rupees in here. You cannot say that I am not able to find where the 1 rupee has went, right? So you have to report each and every detail of these 10 rupees where they are invested in the balance sheet, and only then your balance sheet will represent a true and fair picture. So that means if total sourced funds are rupees 10, then total usage of funds must also be rupees 10. So that means the total size of the balance sheet, I mean the total of funds sourced and total of fund used, must tally with each other, tally with each other always. There cannot be difference between these two sides, right? So now let me erase some things so that you can easily understand. Right now, so let us focus on sources of fund side. Let us focus on one side, that is sources of fund, that is liability side. Now you can source the funds in two ways. One is are the long term funds. You have taken the funds in the business, you have invested the funds in the business, taken the funds in the business. These funds are taken for long term purpose. You are not planning in nearby time to return back these funds to the lenders or the persons who have invested these funds. So these are called non current liability. By non current means there is no current obligation, there is no immediate obligation for you to repay these sources of funds, right? And then the second source is the short term funds. You have taken the funds and these are for short term purpose only. You have to return back these funds to the lenders as soon as possible as per the terms of your agreement. So these are called current liabilities. So there can be two sources of funds. One are the long term funds, which are called non current liabilities, and then the second one are the short term funds, which are called current liabilities, right? Now the question arises, sir, if we say that long term funds are not meant to be paid back immediately and short term funds are need to be paid back in immediate future, so there must be some defined standard timeline followed in the accounting industry, which by from comparison of which we can say that these are long term or these are short term funds. You are right, friends. This timeline is of 12 months period. 12 months period. If you have taken funds which are to be returned back in next 12 months, next 12 months means from the date of balance sheet, from the date of balance sheet in next 12 months, if you are able, if you are obliged to repay any of the funds taken, then those funds shall be classified as current liability as short term funds. And if the contract obligation is such that you need not to return the funds in next 12 months, right? In next 12 months means in next 365 days. If you are not obliged to return the funds in next 365 days, then those funds shall be classified as long term funds. For example, if you have taken a fund from Mr. A, and as per your agreement with Mr. A, you will return those funds after 375 days. After 375 days in full. You will be returning those funds in 375 days in full. That means in next 12 months, you are not obliged to repay the amount to Mr. A, right? So then the amount due to Mr. A shall be classified as long-term funds in the balance sheet as of 31st March 2025, right? But if you prepare the balance sheet on 20th April, 20 days after 31st March, then the remaining period, of these 375 days is now revised to 355 days, since 20 days have gone by. So now the amount due to Mr. A is payable in next 355 days as compared to 20th April. So the amount payable to Mr. A, which was earlier classified as long-term funds, shall now be classified as short-term funds if you prepare the balance sheet of 20th April. I hope I am clear on this point, right? So what are the examples of long-term funds? It is critical for you to understand The first and foremost example that like that I have told you in previous video, that the owner's equity, where equity has a feature that it is always invested for long term purpose, and it only has a residual charge on the assets. It is only paid back when all other lenders are paid back of the business, right? So the owner's capital is the foremost and the most brilliant source of raising the funds for long term purpose. Then the second one is the quasi equity, the loans which you have subordinated, the loans which you have treated as quasi equity, the loans which have features like quasi equity that I have explained to you in previous two videos. Then these loans are also classified as long term loans, since I have already told you these loans, like equity, are not meant to be paid back in near future and are to be retained in the business for as long as possible, right? So the quasi equities are also long term funds. Preference shares and debentures, if you have raised, these are also taken for long term period of 5 years, 10 years, 15 years period. So these are also long term funds. Bank's debt, if you have taken a loan from the bank which is to be paid back in 3 years, 5 years, 7 years, 10 years, then the amount also comes under long term funds taken for the business. And the rest is can be other long term loans. If you have taken any loan from any other person for a long term purpose, then it shall also be classified in long term funds, right? So there is one thing that you need to understand in point number 3 and point number 4. So suppose if you have taken a loan of rupees 10 lakh rupees of 10 lakh rupees from the bank, and it is to be paid back in 5 years, it is to be paid back in 5 years, that means you are returning 2 lakh rupees principal, 2 lakh rupees principal each year, right? So these 2 lakh rupees principal that you are returning back each year, it is payable in the 12 months period. You are returning back these 2 lakh rupees each year, that means you are paying 2 lakh rupees in a period of 12 months timeline, right? So whenever you classify a bank debt or preference share or similarly debentures, you have to classify them in two parts. You have to classify their long term portion and the short term portion. By short term portion, we mean the amount of principal which is payable in next 12 months, due to there is EMI each and every month going for these loans. So any principal amounts which is payable in next 12 months shall be classified as current liability, and the balance amount, like in this example, if 10 lakh rupees is the outstanding and 2 lakh rupees you need to pay back in form of monthly EMIs, principal amount in next 12 months, then the balance 8 lakh rupees, are payable beyond that 12 months period. So in the financials, in the balance sheet, these 8 lakh rupees shall be classified as long term funds and 2 lakh rupees shall be classified as short term funds, right? So this is the thing that you need to care about for the bank's debt and the preferential debentures if they have any redeemable clause, right? So the timeline I have already explained to you, it is of 12 months period only. So the bank debts in long term funds do not include the debt which is payable in the next 12 months. I have already explained to you, right? So the current liabilities are the one which are to be paid back in next 12 months period. So what are the examples of current liability? Read it carefully. The long term loans of the banks or debentures, preference shares, which are payable in the next 12 months period. I have already explained the concept to you. This is a part of current liability or short term funds only, right? Bank's working capital finance, if you have taken any working capital finance from the bank like cash credit limit, overdraft limit, packing credit limit, buyer's credit limit, bill discounting limit, supplier credit limits, channel finance limits, these are all short term working capital finance taken from the banks which are repayable on demand and are renewed after every 12 months. So these loans are technically for 12 months period only. So that is why we classify these loans as part of short term funds or current liabilities only. You have purchased the goods from your suppliers and you need to pay them back in usually 90 days period, 60 days period, 30 days period. So the creditors for your purchases or your expenses are classified as part of short term funds in the balance sheet. Expenses payable, creditor for expenses, I have already explained. You have taken any advance from the customer by committing that I will supply you the goods in next 30 days, 60 days, 90 days for this advance, right? So these advances are also usually knocked off within a period of 12 months. You need to supply the goods to them within these 12 months period. So these are also classified as short term finance in balance sheet, and any tax liability is also classified as short term finance, and any other short term debt if you have taken, then it shall also come under short term finance head in the liability section, right? Now coming to the asset side. Similarly, in the asset sides, the funds that you have taken can be invested for long term purpose or short term purpose. If you have invested the funds for long term purpose, then these are called non current assets. If you have invested them for short term purpose, then these are called current assets. Now, how do we read it? By long term investment, first of all, we mean that there is nothing recoverable from them. There is nothing recoverable from them in next 12 months. We mean to say that these assets shall not provide any money to you by selling off in next 12 months period. You are not planning to sell them off in next 12 months period, not planning to recover any amount from them in next 12 months period, or the investments are of such type, our investments are such type that they are non-recoverable in the next 12 months period. We will discuss some examples. And the second point is, these are generally the investments which help the business run and generate incomes for more than 12 months period. These help the business generate steady income, run for longer period, more than 12 months period. Like, what are the examples? For example, land. If you have bought the land, you have built up a factory on it, offices on it. So this land helps you run your business for more than 12 months period. You don't buy land, build factories on it just to sell this land in next 3 to 6 months, right? So this is your long term investment. Similarly, the building that you have built on that land helps you run your business and generate business in more than 12 months period. This gives you benefits for more than 12 months period. So this is also your long term investment. Similarly, furniture, similarly, motor cars that you have purchased for use in the business. Similarly, any patent rights that you have purchased, any softwares you have purchased, any plant and machinery you have purchased, any computers you have purchased, right? These are all examples of a very good long-term investments that help run your business or grow your business for more than 12 months period, right? So now coming to other examples. Investments in your subsidiaries or group concerns. If you have lent any money or advanced any money to your subsidiaries or group concerns, and these monies are not meant to be repaid in next 12 months period, then these are also classified as long term investments. These are not the assets which help your business run or help your business generate revenue. Although maybe subsidiary, maybe some technical planning of the business, there can be some non business purpose advances as well to them, right? So if so these advances are not recoverable in next 12 months, then they are classified as long term investments. Similarly, any long term advance you have given to anybody that is not meant to be paid back in next 12 months, that is also classified as long term investments. Now these are the critical examples for you to understand. Slow moving stock. You have purchased some goods, some products that your business deals in, and the stock has become obsolete for whatsoever reason, due to some market condition, due to some inherent limitation in that stock, that it cannot survive for a longer period of time if it remain in the factory premises for too long, right? Like agri products, food products, right? So the stock is kind of obsolete, right? So the stock which was meant to be sold in 2, 3, 4, 5, 6 months, in next 12 months period, and give you a money back, which is kind of your short term investment, but since it has now become obsolete, you will not be able to recover any amount from it in next 12 month periods at least. So this slow moving stock is kind of a long term investment of yours. Similarly, the sticky or doubtful debtors, any party to whom you have sold goods on credit and that party has run away, not paying you back, and you are doubting that you will recover any amount from them, right, in next 12 months. So these amounts shall also be classified as long term investments. But friends, there is one catch. to them you have sold the goods. You have sold the goods, right? And from them you have bought the goods. Bought the goods. So if you have bought the goods from them, and due to your financial crunch, or you due to your inability, due to your incompetentness, you are not able to pay them back in the desired period as per the contract period. So you are thinking that don't have any money, so you will not be able to pay them back in next 12 months period, or some court cases going on, right? So this does not give you leverage to classify them as long term source of funds. We always follow a conservative approach while preparing the balance sheet or analyzing the balance sheet. Whatever liabilities you have which were originally meant to be for short term purpose, right, then they will always be classified in short term liabilities. We will always keep on saying that this liability you have to pay, in next 3 months. We will not give you a benefit that you can say to your investors that this liability is not due in next 12 months period. No, this liability was meant to be paid in next 12 months period, then it will remain in your short term funds. But this is not true for your investments. If your investments which was meant to be recovered in next 12 months period and you are not able to do so, then it is your incompetentness. Then we will not give you a benefit for representation amongst the shareholders or investors, saying that these are my investment which will give me money in next 12 months period. No, you can't say it to them. You have to classify them in long term investments, right? FDR in the banks also in long term investment. Share securities investments is also long term investment, right? So these are kind of debatable parts whether to classify them in long term or short term purpose. So that we will unfold in the coming financial analysis classes, right? So stay tuned with this channel as always. So the what are the short term investments, current assets? They are expected to realize in next 12 months period. Expected to realize in next 12 months period. For example, the stock, good stock which I have not become slow moving or obsolete. Good debtors which are recoverable against sales. Advances to your suppliers from which you will get your material in next few months. Tax receivables, for example, GST receivable, or any other short term advance, for example, prepaid expenses, for advance salary to the employees, right? So these kind of expenses. So these are the examples of short term investments, long term investments, short term funds, long term funds, which are crucial part of the balance sheet. This is the only major constituent of the balance sheet that you need to understand about. And now it is totally up to you that you decide which item can be classified in long term, which item can be classified in short term. You have to be conservative. You have to take care of the minds of the shareholders, lenders, investors. So you have to prepare and finalize the balance sheet accordingly, and you need also to comply with the IFRS, International Financial Reporting Standards, that are common for most of the countries, right? So this is the balance sheet. I have presented the balance sheet to you in a T format basically, while actually nowadays it is prepared in a vertical format. This is a horizontal format. I have given the horizontal format just for simplicity sake, so that I can explain the concept much better to you, right? So I hope I have make a basic of balance sheet understood to you, right? I will meet you in the next video. Till then, thank you very much.